Hey, I'm Tim with Premier Property Group, your local home buying specialist. Today I'm sitting down with Kim McGuire with Advantage Mortgage. Welcome, Kim.
Hi, thank you so much for having me.
Yes. Today, Kim is going to help answer frequently asked questions first-time homebuyers have about the loan buying process. So before we kind of get started, can you tell me a little bit about yourself and being in the loan business?
Yeah, so I have been in the loan business for a long time. I think I've done everything from being an office manager, admin work, and then I worked my way through the ranks over the last 18 years to become a mortgage expert, and I've learned quite a bit. Yeah, I've been a loan officer for about 3 years, and I spent a lot of my history processing loans and doing all of the paperwork side of things.
Awesome. So you
yeah.
kind of have all the ins and outs
Yes.
of the loans.
I think I've done everything you can do in the mortgage companies. Yeah.
Nice. So I think the first question people have when it comes to the loan process is, what are the different loans I could get as a consumer?
Yeah, so there are a lot of different loan programs out there, and it really depends on each person's scenario. So the ones that you're going to hear the most about are conventional FHA, USDA, and VA loans. Beyond that, there's lots of different programs that lenders come up with to meet different buyers' needs. So you really just want to make sure you talk to a loan professional and let them figure it out for you, or give you the details to make your decision with.
Nice.
Yeah.
And then as a first-time home buyer, should I be considering certain loans? Are other loans harder to get approved for, or?
I think as a buyer, when you talk to your loan officer, they're going to kind of guide you based on your own scenario as to which program is going to work the best for you. There are programs out there that are, yes, easier to qualify for. Maybe you don't have to have as high of a credit score, or maybe the debt to income ratio maximum is a little bit higher. So yes, there are loans that are easier to qualify for, especially for first-time home buyers.
I would love to kind of come back to the qualifications for loans, but I know, and especially now with higher interest rates, you're hearing more about adjustable mortgages and fixed mortgages. What are kind of the big differences between ARMs or fixed rate?
Sure. So a fixed rate mortgage is exactly what it sounds like. The rate's fixed for 30 years for the life of that loan. It's not going to change. You are locked in. Your monthly payment, as far as the principal and interest amounts are considered, those are going to stay the same. An adjustable rate mortgage is where your rate is fixed for just a period of time. So maybe that's 1 year, 2 years, 5 years. There's different fixed terms, but after that term is up, then your rate can adjust. And if rates are higher, your rate will be higher. If it's lower, then you actually could potentially have a lower interest rate.
Why might a first-time homebuyer choose an adjustable rate mortgage?
Usually when a first-time home buyer chooses to do an adjustable rate mortgage, it's usually because they plan on being in that home for a shorter period of time. Let's say like 2 to 5 years. They're here for work temporarily, or maybe they already know that they have plans to buy a bigger home and upgrade within a couple of years. So most people choose that program just to make sure they have that lower payment while they're in the home.
Oh, nice. So we've kind of done a brief overview of the different loans that are out there. Now, as a first-time home buyer, how do I know how much mortgage I can afford? Is it healthy for me to have half my monthly budget go to my mortgage, or is there kind of a standard that loan officers aim for?
Well, it is going to depend on the loan program as far as what that maximum debt ratio looks like, and it is going to consider other payments that you have to make, like your auto loan, your student loans, credit card payments. So that's something that gets considered in the debt to income ratio. Really, it comes down to what the buyer's comfortable with. I encourage everybody who's a first-time home buyer to really outline their budget. Put down how much they make, how much do they spend on dining out, entertainment, the rent payment. It's really nice to get it down on paper just to see what it looks like. As far as the percentage goes, I think ideally in a perfect world, you would not want to be up against that 50% debt ratio maximum. Give yourself a little bit of a buffer in case things come up, because as a homeowner, things come up. So you're going to have expenses. Definitely. Maybe you have to borrow the money to take care of those expenses. So leave a little gap room in there just to make sure that you can take on additional expenses.
Things definitely come up. Well, last summer, my AC broke during the heat wave.
Of course it did.
Yes. So it turned out for a very hot week.
Yeah. Oh boy, we did that last year too.
So as a buyer, now I decide, I want to go with my conventional loan, and I want to try to get approved for $400,000. What are some of the factors or the considerations you as a loan officer are looking for? And what are you considering in that process to approve me?
Yeah, so it's really based on some main factors. What does your credit look like? What does your credit score look like? Have you made your monthly payments on time? Have you been able to save money, which isn't always a deal breaker. There's loans that don't require much money down, maybe zero money down. So depends on each person's scenario. Work history is another thing that needs to be considered too. Is how long have you been doing your current job? Did you go to school for that job? Typically, we're going to need to see a 2-year history of employment, so that's another factor as well.
Let's say my credit score is a little low right now, and are there resources to kind of help improve that, or do you kind of help guide the buyer in ways to kind of prepare themselves for maybe 6 months down the road? Or
yeah, so we're not credit counselors, but as loan officers, especially one who's been in the business for a long time, we do have an idea of things that people can do to improve their score. So we can give a couple of pointers. If it looks like it needs a little bit more hand-holding or extensive work, we have credit repair services or credit counseling services that people can take advantage of to help boost that score.
You also mentioned in the factor of how much money you kind of can put down or what you can afford. Mm-hmm. Does Oregon have programs to help first-time home buyers qualify for these loans?
Yeah, Oregon does. Like most states, there's going to be down payment assistance programs. There's lots of different down payment assistance programs, maybe some that you pay monthly to borrow your down payment funds, or some that are forgiven and some that you don't pay on but maybe get paid off when you sell your home. Lots of options there. There's also some options that Oregon has to give you a little bit of relief on your interest rate if you fit in the parameters that they've set for it. So usually there's an income maximum for how much someone can earn, and then another one, the Oregon Department of Veterans Affairs mortgage loan, for example, is a program specific to Oregon that typically has a lower rate than a standard conventional loan.
If I do put down a lower percentage, under 20%, are there added requirements for me with those loans, like mortgage insurance?
Yeah, so most loans, if you put less than 20% down, are going to have mortgage insurance associated with them. I'll start by saying that those are usually categorized in 5% increments, so 15%, 10%, 5% down. As you get closer to 20% down, that mortgage insurance tends to be less per month. So, those can range anywhere from $75 to upwards of $300 a month, depending on the credit score and debt to income ratio maximum. Yeah. Mm-hmm.
So, as the buyer, I choose that conventional loan, and I'm fortunate enough to put down that 20%. So luckily, hopefully I don't have to have any mortgage insurance, correct?
Correct.
And then what other costs are there in that loan process? Could you tell me about like mortgage points?
Yeah, sure. So I think it's usually about 2 to 3%, let's say 2 to 3% of the sale price that ends up being the total amount of costs and what they call prepaids that you do have to come up with as a buyer. Sometimes you can negotiate with the seller to get the seller to pay those, but you can just kind of estimate 2 to 3% of the amount of home that you want to purchase as an extra amount that you'll need for closing costs. And that will include lender fees, there's a title company involved, there's title fees, and prepaid property taxes, homeowners insurance, and interest that you pay. And as far as discount points go, that's a loaded question. So discount points are usually associated with the interest rate itself, and there's something called a par rate, which means there's no discount points involved. Typically that's higher than a rate that you would have when discount points are involved. Discount points, it's kind of counterintuitive, but you do pay discount points to buy down your interest rate and potentially get a lower interest rate. Yeah, which saves you money per month if that is what you're looking to do. Yeah.
You mentioned closing costs and title company fees. So when I get approved for that loan, and I have my 20% down, my 20% down, does it cover those fees?
No, that's strictly the down payment. So the 20%, you take 20% of the purchase price, that is the amount that you'll need for your down payment, and then the closing costs are on top of that.
Okay, so as a first-time home buyer, I should remember that I have a down payment portion, and then I do have my closing costs and my lenders and title fees to go with that.
Yes, correct. And for some mortgage loans like FHA, there's down payment assistance programs that can help you cover the closing costs. Usually about 3 to 5% are the options for down payment assistance programs that you can use towards your closing costs and down payment.
Awesome, thank you.
Yeah.
So this has been great, and I really appreciate your time here with me, Kim.
My pleasure.
When I first met you, I kind of asked you about areas that you feel passionate and have joy in your job, and you did mention first-time home buyers. At the end of this and kind of hearing the questions, what do you think are some big takeaways first-time home buyers should know and remember walking away from this?
Yeah, I think the most important thing is, if you're thinking about buying a home, talk to a loan officer about it. Get the conversation going. A lot of people have these misconceptions that you need to have 20% down or you need to have all of this money in the bank to become a homeowner, and that's not true. There's different programs out there that you might be able to get into a home sooner than you think. And the next biggest thing is just really think about that monthly payment. Rates are a little bit scary right now, but the biggest part is when you look at that monthly mortgage payment, can you afford it? And if you can, then go for it. Talk to somebody about buying that home.
Awesome. Well, once again, thank you, Kim. She's a loan officer with Advantage Mortgage, and my name's Tim with Premier Property Group. I hope you have a great day, guys.